Hello, my name is Trent Chapman with New Future Realty, and today I want to share with you a couple things about taxes and how they affect people in a short sale or a foreclosure. Now, a lot of people have a misconception that letting a home foreclose basically wipes out all liability, all taxes, and everything. You could just walk away from a home. Unfortunately, that's not the case. There are some pretty good laws in California that protect homeowners from foreclosure damages or effects. But that only applies usually to homes that are purchase money primary residence. So that means if you bought the home and used the original funds to buy the home, you didn't refinance or get another loan or HELOC to take cash out, that typically your loans are considered non-recourse, meaning if the home does foreclose, the banks can't sue you for the difference. However, this does not wipe out the tax liability. A bank always has the right, in the case of a loss, to charge off that debt or write off that debt, and also issue a 1099 as if it's income to you for that loss. So say for example you have a home that's a $400,000 mortgage balance on that home, and it was purchase money, meaning you bought the home and never refinanced, and the home forecloses and it sells at auction or afterwards it sells as a bank-owned property for $300,000. So the bank realizes a $100,000 loss. They lost $100,000 and they have the right to issue what is called a 1099-A, and it's for abandonment of debt. And so they'll issue a $100,000 1099 to you and report it to the IRS as income to you. Now, the same may happen with the short sale as well. When you do a short sale, however, usually there's less of a loss. The reason that the banks entertain the idea of doing a short sale is, one, the home's usually in better condition because you don't trash it when you leave a short sale. And two, the home is actually sold for a higher price because the market hasn't depreciated as much. When a home sits vacant for 3 to 6 months and gets vandalized or damaged, and it's in a market that's depreciating, the bank loses more money. So let's say the same scenario where you owe $400,000 on a home, and you purchased that home and never refinanced or took cash out, and the home sells as a short sale. Let's say the bank nets $340,000. There's still a loss of $60,000, and they still can issue what's called a 1099-C for a cancellation of debt. So in this case, instead of abandoning the property, abandoning the debt, the bank is agreeing to cancel the debt, and so they issue a 1099-C. Now, there's not really a huge difference between a 1099-A and a 1099-C. Only the effect that you'll see is a major difference is that the 1099-C is usually for a lesser amount, simply because by doing a short sale, there's usually a lower loss or less loss to the bank. So now that we know that there can be a 1099-A for foreclosure or a 1099-C for a short sale, how can you deal with this taxable income that's reported to you as taxable income? Now, here's the great news. There's actually a couple ways around it that are legal that can actually help you to do a short sale and not have to pay any taxes on that loss. Now, in 2007, President Bush passed a law called the Mortgage Debt Forgiveness Relief Act. Now, that law makes it so that you can do a short sale, or even if it goes to foreclosure, and that loss that you receive is reported as income or as a 1099-A or 1099-C can be written off or wiped away. Now, this applies if it's your primary residence and this is a home that you lived in, not that you rented out or second home, and that the money that it was lost was used to acquire the property. So if it's a purchase money transaction, I didn't cash out $100,000 to buy a boat, some other toys, then that loss is considered non-taxable. And so that's the good news for those that have bought a home, never took money out of it, and either do a short sale or lose it to foreclosure. The government has given you a way to go through that process without having to pay back any of that via taxes. Now, this does not change the fact that if it's a recourse loan and the bank forecloses, they still may be able to sue you for that balance. Now, that's another subject, another topic, and we'll go over that in another video. But for the purposes of taxes and loss, there's also a way to be able to write off or show that you're not liable for that tax loss through what's called a Form 982. So if you talk to your CPA and ask him about Form 982, say, okay, how does this apply to me in a short sale or foreclosure? If the bank sends me a 1099-A or 1099-C, how can I use this Form 982 to show that I'm insolvent? Now, if you're insolvent, meaning that your tax liability associated with the loss of that home causes you to have more tax liability than you can actually pay, so that means you have no assets, then in many cases you can show that you're insolvent and you're not liable to pay the taxes or pay the loss for those taxes. So that's good news for the people that truly are going through a hard time and don't have the money to pay the taxes. You're most likely going to be able to show that you're insolvent. Now, if you talk to your CPA, more than 90-95% of the people who do a short sale end up being insolvent or qualify under the Mortgage Debt Forgiveness Relief Act of 2007. The great news is this act that was passed by Bush was extended by Obama through 2012. So we've got a year or two left before this act expires. And make sure that you do a short sale, if you're going to do a short sale, before that time, so you can take advantage of the temporary tax breaks that are currently in effect in this market.